Hello, everyone. It's Trevor at Heritage Reverse Mortgage. We are Southern Utah's reverse mortgage specialists. My article today talks about the tax changes of 2018 and likewise goes into detail about how reverse mortgages and mortgage interest are used in regards to your taxes and tax deductibility. And so in the article, I explain that with reverse mortgages, the homeowner has no required payment. As long as they're living in the home as their primary residence, they do not have to pay principal and interest until they pass away or until they move out. And so with the right financial planning, this could be a real powerful tool to protect you from tax exposure on those years where you may have more income or you may have more draws from your retirement benefits. And so I explain in the article that with reverse mortgages, because you're not making a payment, the interest is added to the back of the loan. But let's imagine that you turn 70 and you're forced to take a large chunk out of your 401k or your IRA or something. And doing this triggers a tax penalty because it pushes you into a higher tax bracket. Now, if this were to happen, you could turn to your reverse mortgage. You could make a large lump sum payment onto your mortgage, onto your reverse mortgage. This is going to, first of all, pay for your mortgage insurance and your interest. And of course, because you made that payment voluntarily that year, you can now deduct the amount of money that you paid into the mortgage or that you paid onto that mortgage insurance and interest. And so this could help you to push yourself back down to a lower tax bracket and save you a lot of money when it comes tax time. Um, Other things to consider with this, the reason why this is such a great thing is that, as I mentioned, your payments on a reverse mortgage are voluntary. You do not have to make those payments if this is still your primary residence. But if you have set the loan up with a growth line of credit, every dollar you put into the loan is always redeemable, meaning that you can always draw that money back out. And as long as it's sitting in your line of credit, it's going to grow at your growth factor, which on most loans today is about 4.5%. And to top it all off, none of that money you take from your line of credit is taxable. And so again, let's say you take $10,000 from your 401k to shelter yourself from that tax exposure, you pay it onto your mortgage. Your mortgage allows you to deduct that on your taxes at the end of the year, and you could turn around and pull all $10,000 back out, or you could let it sit in there for a year and gain $450. Likewise, you could pull that out and not be taxed on it as well. And so, again, very powerful tool. This is why it's so important. If you're considering a reverse mortgage, you need to talk with a professional and somebody that does a lot of these loans so that they can look at your situation, your circumstances, and give you advice and give you information that is best suited to help you long term to make the right decision for you and your family. And so, if you have questions, you or somebody you love, if you'd like to get more information from us, call us today at 435-359-9000, or you can visit us at heritagereversemortgage.com. Thanks and have a great weekend.